What's up guys, welcome back to another YouTube video, and today we're going to be doing a stock market portfolio update, as I've been requested a lot about me updating my previous portfolio update because it did very well on YouTube. I got like 7,000 views, which is incredible support, lots of likes, so I really do appreciate it. Like, honestly, thank you so much for the support, it does mean a lot. And the big thing is as well, like, people say, oh, I want to check out your portfolio now because it went up even more. Well, people would assume it went up even more because Palantir went up a lot and compared to my previous one, and my previous portfolio was up a lot as well, so people are very intrigued and want me to show them the portfolio. And yeah, it has changed, and that's what we're going to get into it. So let's see how it's done. So the first one is Apple, of course. As everyone knows, I hold Apple, and it's always 7 shares. We're just holding those strong, and we're up 91%. And it just shows as well, like, when you just get into a solid company that's growing over time and they make a lot of money, just holding the good old solid stocks do well. And if you are, this is another thing I want to talk about while we move on to the next stock, because this is a good example and a prime example. And this is why I do just hold the 7 shares of Apple, because I just kind of want to show that for people that are watching these videos, because I know a lot of people are new to the whole trading or investing side of things. And I think it's a good example of like, what type of investor are you? And there's loads of different types of investors. Like, there's dividend investors, growth investors, value investors. And people have also got different risk tolerances, because people go, oh, should I buy this stock or should I go into this? It depends on your risk tolerance. Like, my risk tolerance, when you look through my portfolio, I've got quite a high risk tolerance. Like, that's just the way I am. Obviously, that's going to change with the more capital I start having, the older I get. Like, my risk will change. But if you're young, in my opinion, this is not financial advice because I am not a financial advisor, but taking on a bit more risk, I think, is important, because especially when you're starting off low with like certain amounts of money, you want to kind of build up that capital quick. And I know obviously this comes with a lot of controversy, because people will then say time in the market is the most important, which it is 100%. I don't disagree with that. But I also do think, like, if you're buying a company that's not so gonna give you much returns at all, like maybe more like a value play, and it's just gonna give you that, or let's say the S&P 500, obviously that's a smash, like that's what you should be doing, like putting money away every month. But my argument is, when you're young, like, I just feel like you could put that money away into a stock, take on a bit more risk, that could potentially give you a lot more higher returns, and then you can build up that capital pot quicker. And then once you've got that bigger amount of capital, then you start putting your money into a bit safer plays like the S&P 500, or just bigger companies like an Apple, you could say. And Apple has done me solid. I'm up 91% on Apple, and yeah, went on a bit of a tangent there, but I just wanted to get my opinions across. And I know sometimes my opinions and the way I say things, and I watch it back, I'm like, God, I didn't really say how I meant it in my head, and hopefully that did come across how I wanted it to. And yeah, but that's what I love about investing as well. Everyone's got their own opinions on things, and this is what I'm going to get into later in a minute about another stock. So Fubo, this is my highest risk play, hence why I've not got as much money in this one. I've got 800 shares, £911. I'm down 5% at the moment on this. So back when I got into investing in 2021, it was up $52, which is insane. Like, I think valuations just didn't exist back then. I didn't know what valuations meant, so I was one of the culprits for just getting into a stock just because of the hype, I guess. But yeah, Fubo stock is my highest risk play. And the reason why I say that is because obviously, well, they're losing money for a start. I just believe they can turn profitable soon, end of 2025 maybe. And once they can start turning profitable and we start getting, well, their earnings per share turns into 3 cents a quarter or 1 cent a quarter, or just starts turning a profit, then that's when people will start being able to value the company a bit easier and better. And that's when stocks have their big run-ups, and Fubo could have a seriously big run-up within a year if they can turn profitable. And that's the risk I want to take, and that's what I want to put my money in. Obviously, I'm not going to go crazy. I will average in if it goes down more and put in a certain amount more, but I'm not going to go too crazy on Fubo. But that's my opinions on it. And that's, to be fair, with a lot of my stocks. A lot of my stocks I've got into are when they've been losing money, but I saw the potential in the company, and that's what I was going off. And then I kind of reap the rewards in the future. But you look like a madman at the beginning. Palantir, everyone's been waiting for this probably. I've got 546 shares. I'm up 225%. And I was up loads more than this because it went to $68 a share. And it's now been announced that it's going to be in the NASDAQ, which is crazy cool. Like really, really good. So it forces people to buy shares of Palantir. They have to buy a certain amount of shares by a certain amount of time before it goes onto the NASDAQ, I believe. So that forces a lot of buy pressure. Obviously, I had a run up to $68. This is the other thing as well. You have different kind of valuations on things, in the sense of, like, I can say to you now, my portfolio is this in the title, but in my head, I know mentally that it could go down to this kind of price, a certain price in my head. And it's hard to say, because obviously a lot of my stocks, for a start anyway, they're not like you can kind of look at the PE ratio and go, it's trading at the right PE ratio. You can't really do that with certain stocks, in the sense of Palantir. This is because it's caused arguments online. Like, people say it should be trading at this. Some people say it's trading for this. It depends on what someone's willing to pay for the stock, for the price. And granted, it is overvalued right now. It is. And the PE ratio is very high. What is it saying on here as well anyway? 289. So it's like, I think it is like in the 300s, because I think this is outdated, which is a very high PE ratio, ridiculous. And that's why I do think it will drop to its 40s. And that's why I was saying in my previous one, I wouldn't recommend buying Palantir in the short term right now. Like, there's the risk to reward ratio isn't that good. Like, the next 2 years, Palantir could trade sideways, or if not downward, for the next 2 years, because of how much it's ran up, and it needs to reflect that valuation, obviously. So we need to see if they can hit them 30% revenue gross. And that's the other thing. If they miss that, this will tank. So yes. But anyway, what I meant by the PE ratios as well is, obviously, let's say Meta stock or Apple, Amazon, their PE ratios are like 25, 30. They're valued at a good price, and it's worth putting some money into them stocks at them prices. You're not overpaying for that stock, and they are trading at the right prices. Whereas right now, like, it's just really hard to determine a value of the company. For instance, ChatGPT, weren't they valued at 150 billion? And the market cap of Palantir is 120 billion. And I don't think ChatGPT make any money, do they? Or nowhere near as actually they do. Like, I don't know if they turn profits though. I don't think they do make money, like actually profits. But Palantir does. So, but people value in ChatGPT because of the potential of that. So that's what I find interesting. And yeah, I know it will cause a lot of controversy in the comments, probably in my YouTube channel, and I know it does it all online, but it's just about seeing the potential of a company as well. PayPal, we are up 55%, got into this earlier in the year. I saw it was very undervalued at the time. I think the PE ratio for a start was like 11, something crazy like that. It's now 19, still undervalued, and it's still got potential of doing a lot more of a run up, because as well, I think I heard that PayPal will be buying back their own stock, about 3 billion worth, which will also help the EPS, the earnings per share, which is obviously good for us as investors, because it will reflect better and each share will be earning more than they are. That is a good thing, that they're buying back their stock. and also they also see it as a cheap price themselves. So PayPal, I believe, has got more to go, and the CEO with his new changes will now start to reflect in these new quarters in the earnings. So this is what I'm excited to start seeing. SoFi. So what a crazy stock this is. I wanted to buy more of this and still kind of thinking about it, but I'm waiting for a drop. I'm not going to be that person that just keeps buying. I'm going to wait to see if it can have a bit of a correction. So that's what I'm going to be waiting for SoFi. I'm up 74%, and it's a really, really good stock. The member growth and everything is just growing with SoFi. They're profitable at the moment. It's going really, really well. And I think they're going to be one of the biggest kind of banking apps eventually. I think they could easily do that. And also, obviously, it's like a technology business at the same time. So it's a bit of a weird crossover, and there's nothing out there in the market that's like SoFi at the moment. Yeah, it's quite cool to see that we're up 74%, because a few months ago we were break even. Tesla's just had a stupid, crazy run up the last few weeks, month or so, and we're up 58%. And yeah, Tesla's Tesla. We all know my opinions on Tesla. I think it's a crazy good company to have in your portfolio for the next 10 years, to be honest. And that's why I hold it. And it's got so much more than just a car company. People need to stop valuing Tesla as just a car company, because it's not. It's just not. And their solar industry, the solar company in itself, is growing very quickly. And all the other different companies that they've got coming are just going to be good. So I'm going to be bigger than the car company. So Tesla's got so much more to run, and I don't think people realize that. But yeah, Tesla. This is my portfolio. As you can see, 54,000 in it. I'm up 111% in the return. So I've got £54,000 in the portfolio. So it's looking good. If you did enjoy this video, hit the thumbs up, subscribe if you're new. If you want a free share, check out the link in the description. You get a free share up to £100 or Trading 212. And yeah, see you guys in the next one.